How's it going today, guys? I'm excited to bring you another guest video, this time from Ale's World of Finance, one of my favorite investing channels on YouTube. He is going to talk to us today about reading a balance sheet. He has a channel dedicated to stock market news and other financial topics. If you enjoy this video, make sure you jump over to Ale's channel and thank him for making this video. The link is in the description below. So let's learn more about reading a balance sheet.
All right, thanks Ryan, and thank you for letting me come on the channel. It's a huge privilege. By the way, Ryan, one of the nicest, most educated guys I know, and one of my favorite YouTubers out there. So I think all of you are in really great hands. And with that, I'd like to say hi, my name is Ale. As Ryan mentioned, I'm from Ale's World of Finance. And on my channel, it's very similar to Ryan's. I talk about financial topics and the stock market, things like that. Lately, I've mostly been talking about the stock market and stock market news and stocks that I'm investing in, things like that. So if any of that appeals to you, consider checking out the link in the description below. I'd love to have you. But with that, I'm here today to talk to you guys about balance sheets. And you know, whenever I'm investing in a stock, it's very much the case that I always look at the balance sheet. And I wouldn't say that a balance sheet is necessarily the end all be all, but I think it's definitely a great place to start. And so whether you are looking at a stock to invest in or just setting up a balance sheet for your own business, I think it's very important to be able to understand a balance sheet. And balance sheets are important because if a company comes down on hard times, a strong balance sheet can really help them pull out of that. And so they can invest, they'll have money to invest into different things to help them pull them out of that hole that they've dug themselves into. And a balance sheet also makes you very attractive, makes you a much more attractive candidate for an acquisition. And so if a company is considering acquiring another company, they'll definitely look at their balance sheet because that's something that they're acquiring. And so if you have a strong balance sheet, that makes you much more attractive in that sense too. So a balance sheet can be very beneficial for many different reasons. And you can look at the past history and how they're doing now and how they're doing in the future. And if their balance sheet keeps improving, that means that the company has really good management, right? So there's a lot of different things to look at and consider. So in today's video, we're going to cover the balance sheet step by step. I'm going to talk to you guys about all the different terms, how to understand it, and what are some of the things that I look for when I look at a balance sheet. So with that, let's go ahead and get started. All right, so I'm going to start by explaining a couple of basic components that make up a balance sheet. So what is a balance sheet anyway? Well, in its most basic form, you can just think of it as a statement of the assets, liabilities, and equity of a business. So those three components really make up a balance sheet, which is the assets, liabilities, and equity. And a balance sheet helps you understand what kind of financial conditions the company is in. So how is it doing overall? How has it done in the past? You know, how may it do in the future? If a company has done very well in the past with their balance sheet and they continue to improve, then that means that they're trending positively. The balance sheet is likely to keep improving and to keep getting stronger. And so that's really a great positive sign for the company and for their overall business. Okay, now another thing that I want to mention is that a balance sheet is really part of three financial statements, which also include the income statement and the cash flow statement. And even though this video is focusing on the balance sheet, I'll still show you how to find the other two on the website because they're really just right next to the balance sheet anyway, so it's very easy to click on. Okay, so now what are assets, the first component of a balance sheet? Well, those include cash, short-term investments, long-term investments, and other things like that. And in a second, we're going to break down that category even further. Now, when looking at liabilities, that basically includes things like short-term debt and long-term debt. When looking at equity, in simple terms, the equity is what the company is worth. And so when you are looking at a company's equity, you're really considering their net assets, their net worth, or their net capital. And so all those terms are used pretty much interchangeably, but it's basically what the company is worth. And so to find the equity, it's very simple. All you have to do is subtract the total amount in liabilities from the total amount in assets. And so now if that number is positive, then that's a really good thing. But if that number is negative, then obviously that's a bad thing. Now there's one more thing that I want to talk about, and that's something that's called working capital. And this is a very useful tool to see how the company is doing more recently and how they're doing day to day. And so to get the working capital, all you have to do is subtract the current liabilities from the current assets, and then you get the working capital. And so a lot of investors like to look for a positive working capital with a ratio of at least 2 to 1 for it to be considered good. And then the higher that ratio goes for current assets, then obviously the better, right? So that's really what you're looking at there. Okay, now what do I personally look for when I'm looking at a balance sheet for a company? Well, to give you a general answer, what I do is I take the cash and the short-term investments and the long-term investments, and that gives me my first number. So then I add up the short-term debt and the long-term debt, and then that gives me my second number. And so then what I do is I look at the ratio between those two numbers. So if it's like a 2-to-1 ratio in favor of the assets, then I consider it a good balance sheet. And obviously, if that ratio increases, it gets even better, right? So 3-to-1, that's really good. 4-to-1, that's outstanding. And so that's really kind of what I'm looking for. All right, so now let's take a look at Disney's balance sheet. So first thing you're gonna do, open up your browser and type in nasdaq.com. And then in the search bar on the nasdaq.com homepage, you can just type in the ticker symbol for the stock you wanna look at. And in this case, we're gonna look at Disney, so ticker symbol DIS. And once you are on the stocks page, just look at the guide on the left-hand side and click on income statement. Now you get to this page and you can just go ahead and click on balance sheet. And obviously the other two are listed right here as well, income statement and cash flow. But we're gonna look at balance sheet, so go ahead and click on that. And whenever I talk about a term or a figure, I'll have that term underlined so that you can spot it easily. All right, so starting at the top here, we can see that the values are in thousands. So keep that in mind as we go through here. The numbers may seem small on the page, but it's really because they're in thousands, so they're actually much larger numbers, and so we'll cover that. Okay, next up here we have period ending, and so this is showing you the year that you are looking at for these numbers. And so we have here 2016, 2015, 2014, and 2013. Now, if you want to look at quarterly data, then all you have to do is just click that button right above that. But for these purposes, we're just going to look at yearly data. Now, one more thing that I want to mention is that in this example, we'll be focusing on 2016 numbers, but I highly, highly, highly recommend that you always look at prior years. Not just prior quarters, but also prior years. And the reason for that is because personally, I try really hard to be a long-term investor. Now, I say try because I've recently downloaded the Robinhood app, and that has 0 commission costs, and that's been tempting me a lot to make a few short-term plays. But for the most part, I try to be a long-term investor, and so it's very important to look at prior years and to see how they're trending, because I like to hold a stock for several years if possible, especially with a stock like Disney. I mean, that's really a stock you could just kind of hold for the rest of your life. But anyway, that's besides the point. So now let's start by looking at these terms. So first up here, we're looking at current assets. And so when we look at current and long-term assets, we're just talking about how liquid the assets are. And when I say that, I'm just talking about how easily that asset can be converted into cash. Now, current assets are considered as cash, or something that can or will be converted into cash within the next 12 months, and probably a lot sooner than that. Okay, so first up in this category, we have cash and cash equivalents. This is pretty much considered liquid. And so I like to just kind of think of that as just basically cash here. Now, we see that Disney has $4,610 million there. They've got 0 in short-term investment, which I usually consider to be very similar to cash. Maybe it's like a really short-term stock, maybe like 3 months or even less, something like that. So I just kind of consider it like cash. Now, net receivables is sometimes broken down into different sections, but all you need to know is that it is basically payments that they haven't collected yet. So it's money that will be coming in within the year, and most likely a lot sooner than that. And Disney is over $9 billion in this section. Now, inventory is pretty self-explanatory. Disney is extremely well diversified, so they have a number of products, and so obviously they're going to have a lot of money in inventory. And here it's about $1.4 billion worth. Finally, we have other current assets. That could be a number of things, but just keep in mind that it can be made into cash pretty easily within the year, probably a lot sooner than that. And so we have total current assets at $16.96 billion, so a pretty large number there. Okay, next up here we have the long-term assets, and these are generally long-term investments or just assets in general that will not be liquidated within 12 months. And so this can be because the company just won't really see much upside to those investments unless they hold them for at least 12 months, so something like that. Okay, first up in this category we have long-term investments at $4.28 billion, and again, this is just investments that they plan to hold for at least 12 months. Next, we have fixed assets at $27.3 billion, and fixed assets can be things like land or buildings. So think of it as assets that you wouldn't really plan on selling, but you can if you want to. It's just not very likely, and especially not likely within these 12 months. Okay, next up here we have Goodwill at $27.8 billion, very high. Now normally I don't really pay a lot of attention to Goodwill because it has a lot to do with what the brand is worth, and so I feel that it is a little bit of an arbitrary term or category. I feel that it's a little subjective in that sense. However, I do feel that Disney does have one of the strongest brand names in the world, so it does make sense that they would have a fairly high Goodwill. But usually I try not to let Goodwill factor in too much into the stocks that I'm picking, but of course it can be a very good thing. Ideally, you still want to see a high Goodwill, definitely a positive. Okay, next up here we have intangible assets at almost $7 billion, and obviously Disney will have a lot in this category given all of the intellectual property they own and copyrights and patents and things like that. Okay, next up here we have other assets at about $8.6 billion. And again, this can be a number of things, but it's very likely to be assets that will not be liquidated within 12 months. Okay, finally we have deferred asset charges, and this is at $0 for all 4 years. Honestly, I almost never really see anything in this section and I don't pay too much attention to it, but you can kind of think of it as like a prepaid expense. For example, maybe they paid for a service but didn't receive the service yet, and so they count it as an asset. All right, next up here we have total assets at over $92 billion, so very, very high. Okay, we have the third category here, and that is liabilities. And this one is split into current and long-term, very similar to assets. And so when looking at current liabilities here, we have accounts payable at the top with $9.1 billion. And this is just bills that need to be paid. And so we have bills that we know we need to pay and we just haven't paid them yet, but we'll likely pay them within 12 months, probably a lot sooner than that. Okay, next up here we have short-term debt at $3.6 billion. Pretty self-explanatory, just debt that is due soon, especially within 12 months, probably a lot sooner than that. And finally, we have other current liabilities at around $4 billion. And so we end up with total current liabilities at $16.8 billion. Still kind of high there a little bit. Okay, now looking at long-term liabilities, we start with long-term debt at over $16 billion. Pretty self-explanatory, just debt that doesn't necessarily need to be paid within 12 months. Other liabilities at $7.7 billion, self-explanatory there. Next up, we have deferred liability charges at $3.6 billion, and that's sort of like future liabilities. Miscellaneous stock is at $0, and I don't normally look at that one too much, to be honest. And next up here, we have minority interest at over $4 billion, and I guess what that is, it's sort of like if the company needs to buy out a minority stake within the company, then I guess that's sort of what that is. Finally, we have total liabilities at $48.7 billion, pretty high, to be honest there. Okay, so that's pretty much what I look at. The final category of stockholder equity isn't really that important, but you can see that total equity there is at $43 billion, so that is very high, very nice number there for total equity for Disney. Now, if you were to look at the ratios, they're actually not that great for Disney. In fact, the working capital is only like a 1-to-1 ratio. So depending on the type of investor that you are and how much weight you put on these different ratios, then it might be something to consider. But because Disney is such a huge stock with so many different assets and the type of company they are, I still feel that this is a pretty strong balance sheet, to be honest, and very nice total equity there that we have as well. So I'm obviously still very bullish on Disney. Okay, so that's all I got for you guys today. So I hope that you enjoyed the video. I want to say thank you to all the viewers. Hopefully you learned something. Hopefully you enjoyed the video. I definitely had a lot of fun hanging out with you guys and hanging out here on Ryan's channel. So I want to give the biggest thank you in the world to Ryan. Definitely, again, one of the coolest guys I know, definitely a friend of mine. And I think it's a very classy thing, a very nice thing that he's doing on here, inviting some of these smaller YouTube channels, helping grow the community. Definitely a very nice thing for him to do. So thank you to Ryan. And I want to say that I hope you all have a wonderful, beautiful day and that you all take care. Bye.